Welcome to Market Lens. I'm Daniel Reed. Tomorrow, May 6th, is being called Mega Wednesday by Wall Street. Before the opening bell even rings, we will have results from two of the most influential consumer giants in the world, Disney and Uber. And then after the closing bell, DoorDash will round out the day. We are at a critical juncture in the 2026 market cycle. Investors are looking for proof that the efficiency era is translating into durable, long-term growth. Today, we are going deep. We aren't just looking at the EPS estimates. We are looking at the leadership transitions, the autonomous moats, and the weather-driven resets that could define the next 6 months for these stocks. Let's start with the House of Mouse. Disney is scheduled to report its fiscal second quarter results tomorrow morning at 6:40 a.m. Eastern. Over the last month, the stock has seen what analysts call moderating momentum. After a strong start to the year, the stock has pulled back as investors digested headwinds in the experiences segment and shifting travel patterns. The consensus is looking for revenue of $25.03 billion and an adjusted EPS of $1.49. But for the first time in years, the most important thing isn't the numbers, it's the person delivering them. This is the first major earnings call under newly appointed CEO Josh D'Amaro. For the last decade, every Disney call was viewed through the lens of Bob Iger. Tomorrow the market is looking for the D'Amaro vision. Is he here to maintain the status quo, or is he ready to accelerate the transition to a tech-first entertainment company? The second hidden factor is the streaming durability test. Disney has guided for roughly $500 million in operating income from its combined streaming business this quarter. But the market isn't just looking for profitability, it's looking for sustainability. With the password-sharing crackdown and recent price hikes, analysts want to see if the churn is staying low. If Disney can prove that Disney Plus and Hulu are must-haves, even at higher prices, it completely re-rates the stock as a high-margin software play rather than a legacy media firm. Finally, we have to look at the experiences segment. This has been Disney's profit engine for a century. However, management warned of modest growth this quarter due to pre-launch costs for the Disney Adventure cruise ship and the World of Frozen expansion in Paris. The unique insight here is whether these are truly temporary costs or if we are seeing a broader cool-down in domestic park attendance. Watch for D'Amaro's commentary on international visitation headwinds. If the domestic consumer is pulling back, Disney will need streaming to carry the heavy lifting for the first time in history. Next up is Uber, also reporting tomorrow before the bell. The stock has been under pressure lately, down roughly 11% year-to-date, trading in the low 70s. The market is currently struggling to value Uber's transition from a delivery and ride company to a global autonomous network. The street expects revenue of $13.3 billion and an EPS of 71 cents. They are also looking for gross bookings to land between $52 and $53.5 billion. But the real battleground for Uber tomorrow is autonomous vehicles. This is what I call the double-edged sword of Uber's 2026 strategy. On one side, you have the bull case. Uber is forming an autonomous moat through massive partnerships with Waymo, NVIDIA, and Rivian. They recently committed $1.25 billion to a robotaxi fleet. If this works, it removes the human driver cost and dramatically expands margins. On the other side, the bears are worried about the capital burden. Will these partnerships turn Uber into a heavy company with massive maintenance and liability costs? The hidden factor tomorrow will be management's commentary on the Waymo rollouts in Austin and Atlanta. Is the tech ready to scale? And more importantly, is it actually profitable yet? We also have to discuss the macro pressure. Regional conflicts have kept fuel costs elevated throughout the quarter. For the last 2 years, Uber has been GAAP profitable. Investors are laser-focused on whether the company can maintain that profitability if the cost of moving things continues to rise. Watch the implied volatility. Options traders are bracing for a 7% move in either direction. That is twice the historical average. The market is poised for a major breakout or breakdown for Uber tomorrow. Finally, we have DoorDash reporting after the close tomorrow. If you want to understand consumer spending in 2026, you look at Dash. The stock hit a monthly high of $191 back on April 20th, but it has pulled back to the $172 level heading into this report. Wall Street is looking for revenue of $4.15 billion and an EPS of 41 cents. That would represent a staggering 37% year-over-year growth. But here is the deep insight that most people are missing. DoorDash is no longer just a food delivery company. It is a logistics layer for the city. Management has highlighted that 30% of their customers are now ordering from new verticals. That's grocery, alcohol, and retail. The unique factor to watch tomorrow is the unit economics of these verticals. Historically, grocery delivery was a money loser. DoorDash has promised that these categories will turn contribution margin positive by the second half of 2026. Tomorrow, we need to see the proof of concept. If they can deliver a bag of groceries with the same efficiency as a bag of burgers, they effectively double their total addressable market. However, there is a weather-shaped elephant in the room. In Q1, the US was hit by severe storms, Gianna and Fern. Management has already hinted at a $20 million direct hit to the bottom line from these storms. The logical analysis here is whether the market will look through this weather hit. If DoorDash beats on growth but misses on margins because of the storms, it creates a reset narrative. It gives investors a chance to buy the growth at a temporary discount. Also, watch for updates on the Deliveroo integration. DoorDash is making a massive global play. Are they winning in Europe, or are they getting bogged down in a price war with local competitors? When you step back and look at these three reports together, you see a common thread. Disney is fighting to prove that legacy media can transition to a high-margin digital future. Uber is fighting to prove that its autonomous network is a reality, not a dream. And DoorDash is fighting to prove that it can deliver anything to anyone at a profit. Tomorrow morning, the tomorrow era and the autonomous moat will be put to the test. And by tomorrow night, we will know if the American consumer is still ordering or if they are finally pulling back. I'm Daniel Reed. See you after the numbers hit.